Welcome, viewers, and thanks for tuning in to WACA TV's new business series, True Business Ownership with Rita Coco. I'm Rita, and I welcome you to this second episode of our new business series. And if you have been here before, please welcome back and stay with us. And if you are new, there is a first series on this TV's website. Don't forget to take a look at it. It's gotten rave reviews. I have been a business coach and business consultant for 21 years, and I work with small business owners. And what I have found is that although they're great and they were very successful taking their business from one level to the next level to the next level, it wasn't without struggle, and it certainly wasn't without sacrifice. And as I saw that tiredness and yet happiness about getting to the next level, there was also reservation about how far they wanted to take their business. So I did something about it, and I put together a true business ownership program. And in that program, there are steps, 12 steps, not the 12 steps you kind of think of, but different 12 stages. And in each of these stages, I have designed best practices along with my partners as to how to get through a stage with ease. So each one of these business episodes that we will be airing every month has two major things. Well, actually, let's say three major things. The first one is that we will teach you to have the relationship you want with your business. No more struggle. The second thing is we'll teach you how to have the business you want. And third, there'll always be an expert or someone with a great story to tell you how to go about being the best owner you can be and a true business ownership rather than a traditional one. So today I do have an expert with me, and we are going to be talking about business valuation. Now, before you take that remote and start to press that button that says, wait, business valuation, I'm 30 years from exiting. I know business valuation is something you do when you go to sell. Well, here's a new mindset for you. It's not that way in true business ownership world. You will think about business valuation now so that you get the dream price you want for your business 30 years from now, 20 years from now, 5 years from now. Why wait to figure out what you're worth when you can do that today? So here with me today is Mr. Dave McLaren. Hello, Dave, and welcome.
Hello, Rita. Thank you for having me. It's great to be here today.
Great. I'm so thrilled, and I know once the viewers get wind of how great you are and what you have to offer, they will be all ears. So before I set you off, Dave, which I know you'll be ready to go, is I want to give the viewers a little bit of background about you. And this is just a small piece, viewers. So let me see if I can have at it the way in which I know in respecting Dave I should. Dave is the founder of one of the most successful and fast-growing CPA firms in Central Massachusetts, and they have three types of folks there for you: tax strategists, forensics accountants, and business valuators. Now, Dave graduated cum laude from Bentley with a BA in accounting. Now, although he's worked his trades a lot, his trade in all different independent companies, once upon a time I said, Dave, you're really good at math. And he said, I started doing accounting at the age of 12. I wasn't doing business coaching at the age of 12, so I got to give him a lot of credit. And so Dave has many titles. Now I'm going to read off these titles for a couple of reasons. If there's a financial person on here, you're probably going to get these titles. If you're not financial, but someone said to me, you need one of these people, it might just click. So here we go. And we have to say that we kid Dave because he has so many titles that, his name follows A through Z with all these titles. Certified public accountant, a chartered global management accountant, a certified forensic accountant, a certified government forensic accountant, a registered forensic investigator. Yes, we do call him Monk, right to his face, and he knows it, and a certified forensic advisor. So with all these impressive titles, today, Dave is going to be our business valuator. And he has been a business valuator for 16 years. He's done business valuations for businesses, business partners, divorce cases, short and long-term exits. And as they say, without further ado, please welcome founder and managing partner of McLaren and Associates CPAs PCs, Dave McLaren.
Thank you, Rita. I'm excited to be here. I think we can have a lot of fun today and get some information too.
I'm so good. I'm so ready. So let's start off. We know that the title of our show today, episode 2, is What is my business worth and how can I tell? And what I want to ask, let's get right out the gate. What is someone's business worth? And where do we start, Dave?
Well, a business valuation is both an art and a science. People don't realize that there's actually a lot of judgment when it comes to business valuation. And one of the keys is, who is the buyer? And we're going to get to that a little bit later to show some examples. But where does it really start? One of the first places is cash flow. What is cash flow? I'm going to try to make today as simple as possible. Obviously, this gets incredibly complex with lots of details, all kinds of research that has to be done and comparisons, but let's try to keep it very simple today. Cash flow is the money you have left after your company pays its bills. Another term you may also hear when you're talking about business valuation is EBITDA. What is EBITDA? EBITDA is earnings before interest, taxes, depreciation, and amortization. For today's purposes, what does all that mean? Cash flow, profit. What is the buyer or the owner going to receive for money after the company pays its bills? Yes, there are adjustments in there, but to make today simple, it's the money you have left over. Now, where do things stand? What do you do here? Well, cash flow is something that we measure, and we usually use 3 to 5 years. We start taking averages to try to come up with a trend. What is a business valuation really doing is trying to show a buyer what is the cash flow they're going to receive in the future. Not necessarily what you're getting today, but what will they receive in the future. So we normalize your profit. That means we're going to adjust your profit. I'll give you some examples. Maybe your spouse does your bookkeeping and they don't get paid for it and they just do it to help you. But if I buy your business, the first thing I have to do is hire a bookkeeper. That means that you actually might be less profitable if I buy the business. On the other hand, maybe you run your Lamborghini through the business. Maybe the Lamborghini can be defended for tax purposes. That's awesome. But for a buyer, chances are they don't need a Lamborghini. And if that Lamborghini is costing $75,000 a year in expenses, we're going to add that back to your profit because the buyer will get to keep that money. And one of the other things is there could be unusual things that happen in the business. We see this today more than ever. COVID has caused a lot of businesses to really take a big hit or to take off. Well, if it took a big hit, but things are now getting back to normal, we might just throw all that aside and go, don't pay any attention to that. As long as we don't have COVID, this business is a strong business that will go forward. Same if it took off and now it's going to settle back down. We will make adjustments for that. The key is showing what a buyer will receive when they buy your business. And that's really the key and starting point.
Oh my. Wow, Dave, a lot. And I know you're so good at explaining it and keeping it simple, and I'm thrilled that you're doing the same here today. So it does sound complicated. Are there other, I know there's got to be other things here that you need to talk about and keeping it simple. What are those?
So those are some other things that we'll call risk, multiples, and return. So let's start with risk. Risk, who determines risk? Well, risk is really determined by the buyer. The buyer is the one, as well as your business valuator that determines how much risk there is in your company. There's risks in certain industries. There's risks in certain companies. Even when there's competing companies that are exactly identical, maybe one, the owner does all the communications with clients. The other one, no one even knows who the owner is. Well, maybe that first one's a little bit harder to sell because maybe I can't just step in the shoes of that owner. Maybe the second one, no one even knows who the owner is. I buy the company, it just continues going forward. So these risks are measured by industry, size of company, what the procedures are and the policies in the company, what your clientele is. A business that's got a whole bunch of clients, if they have contracts too, makes that a lot less risky than a business that maybe has 2 big clients. And if you lose one, you lose half of your business. So to make it simpler, the higher the risk, the lower the value. So we want to address that risk. Return and risk are really married. Return is what, if someone's going to put money into and buy your business, they want to make sure they get money back. They want to make sure they're making money on their money. They can go to a bank. If they were to put $100,000 to buy your business to have even numbers, they don't want a return of $100. They could put it into a bank and get that with no risk and a guarantee. They could put it in the stock market. Maybe they make $10,000. So determining what that return is also what your appraiser does and your buyer does, because you want to show that the higher the return, unfortunately, the lower the business value, just like risk. And then multiples. Multiples you'll hear about, hey, I heard my business can sell 1 times my sales, or 3.5 times my profit, or 3.5 times my cash flow. That's very common. In my profession, we actually have to defend what those rates are. So we actually create these return and risk rates and show how they come up with them and how they're used for the across the country industry standards and other transactions. Lots of comparatives, but those are some of the other side of the transaction. Cash flow over here, and you've got returns and rates on the other side.
Sounds like a whole bunch of different pieces. So we're getting to how much the company is worth. So talk about calculation. How do you do the calculation? Where are you getting the numbers, Dave?
So we use something called capitalized earnings. Some people use multiples. They're just inverse relationships. It's the same thing. So capitalized earnings basically means I have my cash flow on this side. I'm coming up with what my risk and return rate is on the other side. I'm just dividing the two numbers. The reason most business valuators use that is because if we ever have to testify in court, showing what your cash flow is might be a lot easier than defending what rate did we use? How did we come up with that? And it's broken into numerous sections that we have to defend across the country. People use this number as a standard, but in this industry, they add this. And in this sector, they add this. In New England, they add this. So all that is calculated. So all we're doing is taking the money you make, or more importantly, the money the buyer will make, and we're dividing it by this risk and return rate that we come up with, and that's the business value.
Whoa, okay. That sounds so easy, but why do I know? I mean, it's fascinating. And I know working with you and by your side, there's just so much that goes into it. So will company, let's say I own a business and I go to you and get a business valuation. So you're going to give me one value based on what you've told us so far, that this is your value, Rita, of your company. Are you going to do that?
So most people believe that your value is your value and that's it. But in fact, that's not true. It all depends on the buyer, like we talked about at the beginning. So I'm going to give you an example that might make it easier to relate to. I call it the dentist example. I've got 3 dentists, 3 dental practices. The revenue is the same. The expenses are the same. The profit is the same. Dentist A, B, and C. Except dentist A gets purchased by a private equity company. That private equity company's goal is to buy a bunch of dental practices and sell a big conglomerate to a much larger company. Well, that's all well and good. But the first thing they need to do is have a dentist there, because private equity companies can't do any of the work themselves. They may still need the same bookkeeper, rent, office, everything's the same, which means all they're getting is what the profit of that dental company A is. Dental company B, they go and they sell to a dentist. Now that dentist slots himself right into the previous dental owner's shoes. Now he or she will actually earn the payroll and the profit. Now, they might be making even more money than what the private equity company is. If they're going to make more money, they'll pay more for that company. So that means the value is different between those two owners. And to make it more complex, if dental buyer in this B company is actually a dentist that has other locations, they may go, I don't need the bookkeeper. I have a bookkeeper. So I'm going to take your $50,000 bookkeeper. I get to keep that money. Well, now they'll pay more for the company. Maybe they don't need the accounting firm because their accounting firm is just going to include it with what they already have. Now they get to keep that money. So even between buyers in certain sections, the price could be different. It's all based on that money the buyer is going to get. And then lastly, the example I'd give is, let's say someone like myself goes and buys the business. I'm an entrepreneur. I want to buy the business. I think it's profitable and great. Well, I might be able to drill down into details, but I can't drill teeth. So the first thing I have to do is I got to hire a dentist. And that means I'm going to get much less money. On top of that, I might need a bookkeeper there. Maybe I do, maybe I don't. So it turns out that for anyone who's buying a company, when you sell, the price you're selling for could be different based on the buyer. So knowing who the buyer is critical to price your company right so you can get the most for your company and all your hard-earned money.
Oh my, I love it. I love that dentist story, or the tri-dentist. It's a triptych across the three areas. So that's for sure. So I'm going to ask you to do something I know that I love hearing, and that is to spend a few minutes, 3 or 4 minutes with us talking about horror stories. What do you get for horror stories?
Well, I can think of a recent one where people frequently will come to us when they're selling their business and they've already got a buyer. They've already agreed upon a price. And now they want us to help them with price allocation, meaning how do I chop up my business? I'm selling my business for $1 million. How much do I put to inventory? How much do I put to receivables, goodwill? And we help them do that and save them a lot of taxes there. But the real key is, what are you selling the company for? Recently working with someone that they make $500,000 a year, which is good money. But they already have signed an agreement and are selling their company for $750,000. I can immediately say, ooh, that sounds low. And what's worse is, included in the agreement, the buyer gets their bank account. The buyer gets their inventory. The inventory in the bank account is an additional $600,000. Well, wait a minute. I will tell you that when the people at my firm heard about it, they were so shocked that the price was so low that they said, why don't we get together and we'll buy the company for even more money from him, because there was so much there that he could have gotten so much more. Unfortunately, in that particular case, there's got to be, he probably could have sold that business for 3 to 4 times that amount of money the way the business was currently structured. So if he had a business valuation up front, he could have completely gotten a lot more money for his retirement instead of having to use a lot of his other assets for retirement, which unfortunately is what's going to happen in that case.
Oh, yeah. Those are horrible. And those are just 2. I'm sure you've got more. But,
I could tell you a great one too, a quick great one.
Go ahead.
All right, I had a client actually that you sent me, Rita, years ago, who everyone said, we can't sell this company. The broker said there's nothing to sell here. It's all about the business owner. And we showed that with the business valuation, we could go to a competitor who would want his clients that they could cross-sell. And by the time we were done, when everyone said the business had no value, we proved that the business had $1.1 million in value, sold the company, got the buyer, closed the deal for $1.1 million, and the owner got a $150,000 employment contract on top of it. So it changed his life. So that is a story that when you use a professional, it can also really make a huge difference for you.
Yes, I remember that. I remember you did such a great job on my client. I really, really appreciate it. And it is horrible when you think you can't sell for anything, and then all of a sudden you get in front of someone like you, and it's like, well, let's change that for a moment. Let's change that mindset and look for it. Okay, so there's a bit of winding up we need to do here, Dave, but we have a bit. This has all been fascinating. And I have a question. What is ends up being the key to all of this? What the key to getting that value, the key to being ready for that valuation? As we said earlier, it's not about trying to get in and get that value and then valuation and then sell, which people have to do. That's natural. That's traditional. What's the key here to getting all that, as much as I can, out of all that sweat equity?
The key here, Rita, would be profitability as well as risk. And those are really your area. How do you make the company more profitable is something that you do. And how do you make it less risky? Getting those policies, procedures, and making it so someone else can step in the owner's shoes. That's your department, Rita, and that's something you can really help people with.
Oh, right, right. Well, I guess I'll have to roll up my sleeves and make sure that I'm always thinking, what is that value? And I do, and I'm always thinking that. And thanks for mentioning that, because oftentimes people are thinking, I'll just wait to the end. And yes, every year you can be putting value into your business. And I always love working with businesses on that. This has been great, Dave. So we need to wrap up. Last words, my friend.
Last words would be, don't try this at home.
Okay.
Or work for that matter. Get a professional. Call someone like us. Call us and we'll be happy to help you out, or get a professional to make sure you get what you deserve.
No, there you go. Don't do this on your own. No DIYing, says Dave. Dave, this has been great. Thank you so, so much. I always enjoy some of those stories that I've heard for the first time, and some of the stories I've heard as like, oh, a different way of looking at it. So thanks for being here today. Really appreciated it.
Thank you so much for having me. It was great.
Great. So now, viewers, Dave and I know that we have been talking to you and Dave has been giving some great advice here. He's always wonderful at doing that. But we have made a decision to give you an opportunity to listen, to ask your questions. So we have set up a webinar, and it's a Q&A session, and it's going to happen in May because this man right here is a little busy with taxes too. So we'll go in May and we will listen to your questions, but we don't know how to get this invite to you. So here's what I suggest. Please go to ritacococonsulting.com. My contact page is there. You can open it up and put your name in and your email. I promise not to spam you. I'm looking to send you an invite. So think about that. And if you've even tasted one morsel of great knowledge here today with Dave, we've got more. Episode 3 will be in 1 month's time, and we hope that you will join us. And the title of that is going to be Small Business Mergers and Acquisitions. Again, oh my goodness, isn't that at the end? Remember, stop the traditional thinking and start the thinking of true business ownership, which is a little bit outside of the box. So remember that you can be with us. You can see this TV show when it airs. And it's also going to be on the website, so that is grand. And we're looking forward to seeing you in 1 month to episode 3. So join us next month. Remember, you can join Dave and myself in May to talk about business valuation. Again, ritacococonsulting.com, contact page, your contact information, your name, email, that's all I need. The invite is coming your way. So have a wonderful month, and we will see you soon. Take care now.